Heyo, welcome back IB International Economics students to this video lecture. Today we are going to go over the introduction video to Forex markets. Okay, what is the Forex market? What is exchange rates? What are basically the exchange of currencies? What is it? What is the market like? What is everything? Okay, so introduction. Forex market is the market in which foreign currencies are bought and sold, okay, or foreign currencies are traded at, and it is also the location at which the value of a currency is determined, okay, or the exchange rate is determined. Now, what is the exchange rate? Is the value of a currency expressed through another currency. Now, I know if many students have gone to other countries. For example, if you live in the United States, you may have been to Canada or have been to Mexico. When you go there, you have to exchange your dollars into Canadian dollars or your dollars into Mexican pesos, right? So you have experienced the exchange rate, okay? So for example, one American dollar may be worth 0.7 or 0.8 Canadian dollars, right? So that's the exchange rate. And a Forex market or foreign exchange market is the market at which these currencies are bought and sold at, okay? So every time you exchange your dollars to euros, okay, or your dollars to your Chinese yen, you are exchanging, okay, you are buying Chinese yen by selling your US dollars. Okay, so therefore that's a market. And just as any other transaction, there's also demand and supply. Okay, so let's look at this graph right here. Okay, this is the Forex market for dollars in euros. Okay, dollars to euros. So we can see the supply of dollars and the demand for dollars. Okay, and in the y-axis we have euros per dollar, and in the x-axis we have dollars. Okay, we have a quantity of dollars. As you can see, the supply of dollars is once again sloping upwards, and the demand for dollars is the dollars is sloping downwards. This is standard for the standard supply and demand graph, and it is also similarly translated to this graph right here. Okay, so likewise, this is the demand for euros to dollars. Okay, so this is the same thing. Okay, but this is the dollars per euro. Okay, and it's the same thing. Now, we have to talk about the idea and the concept of appreciation and depreciation of currencies. Okay, what is the appreciation? When does the appreciation of a currency occurs? So the appreciation is when the value of a currency increases, expressed through another currency. Okay, so for example, if one NTD, one new Taiwanese dollar, one US dollar is worth 30 new Taiwanese dollars. But now, US dollar is now worth 40 new Taiwanese dollars. Then that means USD has appreciated. Okay, or you could say Taiwanese dollar has depreciated. NTD has depreciated. Okay, so the appreciation and depreciation. Appreciation is when the value of a currency increases in relation to another currency, and depreciation is when the value decreases in relation to another currency. Now, how do we illustrate appreciation and depreciation? So let's look at this the dollars to euros graph right here. So D0, okay, this is demand. And if demand for US dollars increases, that means appreciation occurs. So demand gets shifted to D1, okay, demand for dollars 1, okay. So the demand curve gets shifted to the outside. That means, what does that mean? That means the price for euros goes up. Okay, so the demand for US dollars goes up, then the price for US dollars goes up. That leads to the appreciation of the US dollar. Now, what happens when the US dollar appreciates in relation to the euro? The euro depreciates. So let's look at the same graph right here, but illustrated in euros. Okay, the supply of euros, okay, has increased when it is changed into US dollars. So it has shifted from SE, from the supply of euros to now to supply euros 1. And that's where the dollars per euro decreases, okay, leading to depreciation. Right here, the euros per dollar increases, leading to appreciation. Where right here, the dollars per euro decreases, leading to depreciation. Okay, so this is what happens in a floating exchange rate system. Okay, that's just one of the many Forex systems. Now, there are basically 3 Forex systems that we're going to be looking at: the floating exchange rate system, the managed exchange rate system, and a fixed, or what we call the pegged exchange rate system. Now, with the floating exchange rate system is when the value of all these currencies are freely determined by the forex market without interference of government or the central bank. A managed exchange rate, however, is a little bit different, where the currency is managed by the government, and they usually have a range. Okay, for example, one currency could be worth $1 will be worth 10 to 20 of a certain currency. If it exceeds that or goes below that, then the government would take fiscal and monetary policies in order to push the currency to the expected range. Okay, and fixed or pegged currencies are another currencies that are tied to a widely traded currency. For example, the United States dollar. For example, the Hong Kong dollar is pegged to the US dollar, and any addition, okay, or subtraction to the US dollars will be directly proportional and reflected through the Hong Kong dollar. So these are the exchange rate systems, and these are the different systems that we'll be examining in this unit, as well as a basic overview of what the Forex market is, the exchange rate, appreciation, depreciation, just major and crucial ideas in this unit. So I hope this video is helpful, and I hope to see you guys in the next one. Goodbye.